Hi, I hope you enjoyed all of our videos thus far. In this video, I'll be talking about the ratio analysis for Kellogg Company. A quick introduction, there are a few things I want all of you to keep in mind as we're looking at some of the ratios for this company. The company is a multinational food manufacturer in 18 countries and sells products in over 180 countries. They offer a wide variety of products such as Pringles, Pop-Tarts, Cheez-Its, Eggo, Famous Amos, as well as other various brands of cereal and other products. And another thing that's very important I want to keep in mind is the market share. Kellogg Company owns approximately 34.1% in the industry, and kind of put that in perspective, you look at General Mills, one of their top competitors, owns 12.8% of the market share. Looking at the liquidity ratios, two that we focused on were the current ratio and the quick ratio. Current ratio is calculated by dividing current assets by current liabilities, and this gives an idea of whether or not the company has enough resources to pay off its debts, obligations, whether they're short-term or long-term. Looking at the quick ratio, this is calculated by subtracting current liabilities from the sum of cash, marketable securities, and accounts receivable. And this essentially is similar to the current ratio, except that it takes out inventory because it's not quite as liquid as the other current assets. And this highlights short-term liquidity, showing creditors how much the company debt can be met by selling off all the company's liquid assets in a short notice. Now looking at the actual overview of, we took a look at 5 different years from 2011 to 2015, and we looked at 5 different companies: Kellogg Company, of course, General Mills, ConAgra Foods, PepsiCo, and Pioneer Foods. In this, when looking at this, Kellogg did have somewhat of a lower ratio compared to its competitors. This is slightly concerning because it indicates that they may have more of an issue meeting their short-term obligations when compared to some of their competitors. And here it shows the quick ratio, which they are also slightly lower than most of their competitors. Next, we look at the leverage ratios for Kellogg Company. The two we focused on were long-term debt to equity and total debt to equity. Long-term debt to equity is calculated by dividing long-term debt by total equity, and this kind of looks at individual ownership such as stocks instead of bonds from outside creditors. And then looking at total debt to equity, this is very similar to above, but it factors in short-term debt as opposed to just the long-term debt. Compared to looking at some of the tables, compared to its competitors, Kellogg's has a much higher long-term debt to equity ratio, which signifies that their financing comes more from their creditors as opposed to own financial sources. And this is slightly worrisome because it means that lenders, investors are not as likely to lend, and their interest is not secure in the event of a business decline, essentially leading to, which would likely deter creditors from lending to Kellogg because they're liable, facing potential possibility of non-repayment. And this is very similar when looking at total debt to equity. They're also, as you can tell, much higher than their competitors across the board from 2011 to 2015. Next, we looked at activity ratios, and the two that we chose to look at were inventory turnover and net PP&E turnover, calculated by dividing sales by inventory, and net PP&E turnover is calculated by dividing total revenue by net PP&E. Inventory turnover identifies how quickly money invested in the product is earning a return. So essentially, this is important because it shows how quickly you're selling your product. Net PP&E turnover shows how efficiently a company is using their long-term assets. And this ratio is a little bit of lesser importance because when finding net PP&E, it can be kind of inconsistent across the board, since leasing of property, plant, and equipment can lead to accounting of different long-term assets, which could throw the ratio off. That said, looking at Kellogg's, they have a lower inventory turnover ratio than their two major competitors, General Mills and PepsiCo, and a higher one than ConAgra Foods and Pioneer Foods, but this does not bode well for them. And then you look at net PP&E turnover, they're right around the same as all of their competitors. Some are slightly higher, but again, this is not necessarily a huge issue because the ratio can kind of be somewhat misleading. Next, looking at profitability ratio for Kellogg Company, the three we focused on were net profit margin percentage, return on asset percentage, and return on equity percentage. Net profit margin percentage is calculated by dividing net profit by total revenue, and this kind of highlights how much of each dollar earned by a company is translated into profit, which is obviously very important. Next, looking at return on asset percentage, this is calculated by dividing net income by total assets, and this kind of indicates how profitable a company is relative to its total assets and how efficient management is using the assets to generate earnings. Lastly, return on equity is calculated by dividing net income by total equity, and this is used to measure the profit generated with the money invested by owners and shareholders. And personally, I think this is a very important ratio that is widely looked upon by investors to measure the success of a company. So looking at how Kellogg fares compared to the competitors, they do have a lower ratio than most of their competitors, with the exception of Conagra Foods and Pioneer Foods in 2011 to 2013. This, again, is not great for Kellogg Company because it shows that they are not necessarily generating profit as efficiently as their competitors. Looking at return on asset percentage, this is a net number, of course. This also does not bode well for Kellogg Company, as they have a lower percentage essentially across the board when compared to their competitors. This shows that they're not turning their assets into net income. And lastly, this is probably the highlight of the ratio analysis for Kellogg. When looking at their return on equity, they are turning their equity into income at a higher rate than their competitors for the most part, with the exception of, you look at PepsiCo in 2015, their ratio is slightly higher than Kellogg Company, but Kellogg's across the board, with the exception of 2014 as well. Looking at General Mills and PepsiCo in 2011 through 2013, their ratio is much higher, and this is great for Kellogg Company. Thank you for watching this video on the ratio analysis for Kellogg Company, and I look forward to any questions you have.